Hi everyone, welcome back to our channel FinJs. So this is going to be the third video of a series that we have started like 2 to 3 weeks back, where we are solving a case study. And particularly in that case study, we have to build a financial model on the basis of the all the informations that we have in our case study, right? So this is a case study about Cinepolis, where an investor is looking to invest in a company named as Cinepolis, right? And we have seen, like, we have gone through the case study, we have analyzed all the things that we have in a case study, and we also like in the last video हमने Excel start कर दिया था and we have interpreted all the informations जो हमें दी गई हैं case study में, and हमने वो manually enter भी कर दी थी in our case study, right? Oh, sorry, in our Excel. Now, in today's video, we are going to actually start a financial model. We will see like what is the basic steps that we need to follow before starting a model, right? And what are the first step, like whether we have to build a schedule, whether we have to estimate the revenue, whether we have to estimate the cost, but all the things that we need to estimate first of all in order to have a complete financial model with us, right? So let's see. Let me open my Excel. This is our Excel, and this is where we have left the previous video. We have just make the income statement, balance sheet, and we have just see like what all the things that we need to kept in mind regarding the formatting of our financial model. So in today's video, let's start with first of all income statement drivers. By income statement drivers, I mean to say all the things, all the assumptions, all the KPIs that we need to carry on, or that we need to enter in a financial model in order to have our income statement line items for the future years. Okay. What I'm trying to say is like we have this much line items in our income statement, right? So in today's video, we will try to build our income statement for the projected years. Like we have revenue, COGS, gross profit, operating expenses, EBITDA, depreciation, EBIT, interest expense, tax expense, and then finally net income. Okay, so we can see like we have given our revenue with us in the case study. Like for the projected years, we have been given our revenue, that is 1550, 1856, 2178, and 2870 till fiscal year 27, right? So what all the things that we need to project is after revenue is COGS. So let me make it very clear, like before estimating or projecting any of the other line items, first of all, we always try to build the revenue, or we will always try to project our revenue. Okay, so in this case study, we do not need to project our revenue because revenue is already given to us, right? After that, we need to project our COGS, GP, operating expenses, depreciation. So let's see like how we are going to build these all the line items. So first of all, let's go to the assumption tab, okay, that we have built in the last video. And now again we will follow like 2 to 3 formatting rules that I have explained to you guys in the last video. And if you have not yet watched the last video, please first of all go and watch that video, and then after that come to here and watch the third video of this series, that is building the income statement drivers. Okay, so first of all, what we need to do is we need to decrease the width of the first column, right? Then pressing Alt WVG to remove the grid lines of this tab, right? And increasing the width of the second column. Now going back to the income statement and copy this header that we have built, the dynamic header that we have built in the last video. Copy this and paste here, right? This dynamic header works all perfect in all the tabs. Now let's write here income statement drivers, right? Now in the income statement drivers, what I have explained to you is that we have the revenue, my pass revenue hai. Then coming to the second line item, that is COGS. So in order to determine the COGS, we have two ways through which we can estimate our COGS. The first and foremost way is like calculating COGS as a percentage of revenue. Like if we calculate the COGS as a percentage of revenue for fiscal year 21, it will come around like 40%, and fiscal year 22, it will also come around like, let me see, if we calculate our COGS, COGS as a percentage of revenue. So this is in percentage, right? So we know like in order to calculate COGS as a percentage of revenue, what we need to do is dividing our COGS with revenue. So I have linked that, and we go to know like it is coming around like 40% and 39.6%. So it is somewhat around 40% level, right? So this is the first way through which we can calculate our COGS, and the second way through which we can calculate our COGS is calculating a GP margin, like gross profit margin. If we have the GP margin, we can calculate the gross profit for the future years, and the same way in which we have calculated our COGS in the previous video, in the same way we can calculate the COGS for our projected years once we have the revenue and once we have the GP for the future years, right? So let's go back to the case study and let's see like what method, like method 1 or method 2, is suitable for this particular case study. Okay, the company has a pen, and in the case study we have given that there are two competitors of the company, PVR and Inox, but now PVR has like acquired the Inox, so it becomes PVR Inox. The company's net sales reached to 1250 million in the most recent fiscal year, and it has an operating margin of 13 to 14% historically. This information is not useful for us, right? Now going back to the assumption and financial projection sheet, here it is written that operating margins are expected to be in line with its competitors. It means that the one thing that make it very clear that this operating margin, this EBITDA, this EBIT is going to be in line with the competitors, that is PVR Inox. So we have to use the data of the competitors in order to find the EBITDA for Cinepolix, in order to find EBIT for the Cinepolis. So first of all, let's keep our focus only on like calculating COGS or a GP margin. So we can go with the any of the method like method 1 or method 2. So I'm currently going with the method 1, that is COGS as a percentage of revenue. Okay, and this thing we are going to as manually hard sorry this thing we are going to make an assumptions for the future years, right? About COGS as a percentage of revenue, like what is going to be the COGS as a percentage of revenue for the future years. So that's why we are going to highlight that in the orange color, in this color, right? This is the part of the formatting that I have explained to you guys in the recent video, in the last video. Okay, now what we are going to do is we are going to take the average of these two, and we go to know like operating margin is, sorry, COGS as a percentage of revenue is this. Now, how we are calculate our COGS? Like we know, like we have a COGS as a percentage of revenue, and we have the revenue with us. So if we multiply revenue with COGS as a percentage of revenue, we will be able to calculate our COGS, right? So let's go to the income statement and link our revenue and multiply with COGS as a percentage of revenue. So we got our COGS for the future years. Now coming to the second line item, that is operating expenses or EBITDA margin. So in the case study, it has been given to us. It has been given to us that operating margins are going to be in line with the competitors. So what we are going to do is that is operating margin, right? EBITDA. Now EBITDA margin. Now first of all we need to calculate that EBITDA margin. For PVR Inox Limited. Okay, and this is a fiscal year 22 revenue. This is a fiscal year 21. All right. Now let's go to the screener or any other website through which we can calculate our EBITDA margin for the PVR and Inox. Okay, I have already opened this tab, that is PVR Inox Limited. And if we see like what is the EBITDA margin for 23 and 22, sorry, for 22 and 21, is operating profit is 106. 106 divided by sales, that is 1331. This comes around like 7.96%. And if we see like what is operating profit for March 21, is going to be negative, so it is irrelevant and it is in a like मतलब बहुत vague figure आ रही है. So instead of taking 21, what we will do is we will take the 20 figure. 20 figure is like 10763414. So we can see like there is an impact of a COVID, due to which our EBITDA margin in fiscal year 22 comes around like 7.696%, and in fiscal year 20 it is around like 31%, right? So what we can do is, instead of taking fiscal year 22, we can take fiscal year 19 EBITDA margin, just to have like the correct figure according to the industry. For the fiscal year 19, we have an operating margin of 587,3086. It comes around 19%. That too fair. So now what we can do is, we got our EBITDA margin. So in the same way, we can calculate our EBITDA margin on the basis of an average of these 2 years for our PV, sorry, Cinepolis, right? So now we can calculate our EBITDA. How? We can go to the income statement, we can link our revenue and multiply it with our EBITDA margin. We got our EBITDA margin with us. So this is how we can calculate our EBITDA margin. Now let's go back to the income statement and link all the things that we have calculated in the assumption sheet. That is COGS from here. Now the GP, that is revenue minus COGS. And then our EBITDA margin that we have calculated in the assumption sheet, that is here EBITDA. Okay, and we can also calculate our operating expenses. So these four to five line items we are able to calculate. Okay, now for the depreciation and amortization, first of all we need to have with us a schedule like PP&D schedule, right? So for that you have to wait for the next video where we will see like how to build a PP&D schedule, and after that we can be able to calculate a depreciation. And in the same way, interest expenses will be there only after we have a debt schedule with us. So you have to wait for the remaining videos in order to calculate our interest expense. And the tax expense we can calculate by assuming that 30% is in the past years and 30% is going to remain same in the future years as well. So what we can do is just link this all. Once we have all the items, it get automatically filled. This minus this, and there is a 30% tax rate, right? So I have assumed it to remain same. And now net income. Okay, so this is an incomplete income statement right now, but like when we have like two more videos, then we will be able to complete our income statement. So you will find the template of this Excel in the description of this video, and I hope you like this video. If you like it, please do subscribe our channel and keep watching financial modeling series with Finchase. Thank you.